Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Welcome to the 3 in 10 podcast for Friday, December 12th, 2025. We're recording this pod on Wednesday, December 10th at 7 p.m. Eastern Standard Time. We're going to be traveling for the next couple of days, so needed to do it earlier in the week this time. I am your host, Scott Slayton, Chief Market Strategist at Capital Creek Partners, and here is your starting lineup. Number 1, the December Fed meeting. The discomforts of reaching neutral. Number 2, regulators ease rules on banks' high-risk lending, implications for private credit. And number 3, Oracle earnings. Mixed earnings fail to quiet AI CapEx fears with respect to Oracle. So back to the Fed. The Fed cut for the third time in 2025 by 25 basis points to a range of 375 on the top end and 350 on the low end. The Fed will reinitiate purchases of short-term treasuries to maintain reserves. I thought this might be one of the most interesting parts of the whole meeting. The balance sheet will begin to grow again. That's very important because funding markets have been under some stress. QT is over. The Fed's balance sheet is going to start to grow again. And what does that mean? It's bullish for liquidity, that thing we always talk about. Rising liquidity is the mother's milk of asset prices going higher. Chairman Powell declared that a neutral policy stance has now been achieved. Okay, mission accomplished, right? He said 3 times during the press conference, we are now in a good place to see how the economy evolves from here, unquote. To us, that's code for we're on hold. The Fed dot plot projects 1 25 basis point rate cut in 2026. This decision was not unanimous, with 3 dissenters. That's very unusual to have 3 dissenters at a Fed meeting. And it just points out tensions within the dual mandate. Half of the camp is worried about inflation. The other half of the camp is worried about the labor market. It's a little bit skewed toward labor. The chairman pushed it over the goal line to get the cut, but there are tensions here and they're not going away. The summary of economic projections reveals that the GDP forecast for 2026 went up, and it went up significantly from September. 1.7% in 2025 goes to 2.3% next year. Powell said that was driven by fiscal policy, very robust AI spending, and a continued strong consumer. He forgot to mention easing monetary policy. Core PCE forecast falls from 3% to 2.5% in 2026 and to basically to target in 2027. That's pretty optimistic, I think. Unemployment is held steady in their forecast next year at 4.4%. So this is a Goldilocks forecast, and I think it's unlikely to play out in reality. We know the Fed can't forecast. They know they can't forecast. And I think this Goldilocks forecast is really probably not right. But if the Fed's forecast is correct, a big if, 2026 is likely to be another good year for investors. Well, of course it would be. If growth is going to be stronger and inflation is going to fall and unemployment is going to stay the same, that's a perfect nirvana scenario. And if somehow they're right, next year is going to be a very good year, I think. On to number 2, relaxed rules on banks lending. So we don't usually comment on newspaper articles, but this one from the Wall Street Journal got our attention. It was in the Saturday, Sunday issue. The weekend edition, I think, is one of the best editions of the whole week. But regulators are easing rules on bank lending. This is Trump deregulation bearing fruit. Finally, we're starting to see some of these deregulatory activities actually begin to impact the markets and economies. So regulators are rolling back rules put in place 15 years ago, post the GFC, that reduced the amount of risky loans that banks can underwrite. That kept banks from lending to private equity-led buyouts or high-growth tech companies. Private credit companies stepped in to fill the breach. And capital raised for lending to private equity-backed companies jumped greater than 100-fold between 2006 and 2024. So that's a lot of lost business for companies like JP Morgan and Wells Fargo and Bank of America. They missed out on significant revenue while private capital companies feasted on their inability to really participate. I had the pleasure of attending a JP Morgan private credit lunch last fall. Very interesting. They are getting much more aggressive in this business. And I think for Jamie Dimon, I think this is almost personal. He really wants to get bigger in this business. There will be more big bank competition for private credit business going forward. I just don't think there's any question about it. And with Fed rate reductions and more competition from banks, I think we may well be exiting the golden age of private credit. I wrote a report on this over 2 years ago about the golden age of private credit. We're not going to the age of lead, but maybe we're going to the silver or bronze age instead. And I still think the backdrop is constructive for private credit, for capable originators and underwriters, but returns are likely to drift lower in 26 and probably 27 too. No catastrophe, no big down cycle, just probably some spread compression and lower returns. Now, number 3, Oracle earnings. They reported a second quarter of 26 earnings per share of $2.26 versus the street estimates at $1.63. That's a huge beat, right? 38% beat. Stock should be up. No, the stock was down more than 10%, and I'll tell you why in just a moment. Revenues were $16.1 billion, up 13% in constant currency. Cloud revenues were up 33% in constant currency, and cloud infrastructure, that's the AI business, was up 66% year over year. Well, why would the stock be down? Well, software revenues, which is a huge business for Oracle and almost as big as their cloud business, were down 5% year over year. That's a problem. But investors are really concerned about free cash flow because Oracle has been spending heavily on data centers, too heavily in our opinion. Free cash flow was negative $13.1 billion in the second quarter. That's spooking investors in the stock. Free cash flow has now dropped sharply for the last 4 quarters in a row. I dug into the balance sheet and cash flow statement in this quarter, and it did not look so pretty. There's lots of debt financing in the quarter to the tune of $18 billion in the quarter. So Oracle is no longer able to finance these big data center build outs through free cash flow. They are borrowing, and they're borrowing a lot to do it. So big spending on AI is now bearish for stocks. And this report points that out so clearly. Oracle and Meta don't seem to get this yet. Every partnership, big deal that they announce with OpenAI or whomever else just makes the stocks go down. They're going to figure this out. Somebody's going to figure this out and start to throttle back CapEx, and then their stocks are going to rally. So do the work, endure the pain of gain, and have investment courage.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.